Hey everyone, welcome back to another episode of AWM Insights. I'm your host, Justin Dyer, Chief Investment Officer here at AWM, joined by Mena, Hanna, Portfolio Manager, and we're talking about taking the right shot. How do you strategically maximize your big plays, right? These are the fun parts of investing, really, right? When do you get to go big? So taking a quick step back, why are we even talking about this? Well, we've redefined what is winning. This is over the last couple episodes, talked about our definition of winning, how to make good decisions to lead to a higher likelihood of winning. And then really, bringing it all together is how do you make sure your kind of the day-to-day or all your actions align with your situation and targets to win? How do you even know how to execute there? So we're going to start to bring this to reality, so to speak, and that's what taking the right shot is. Starting with the higher growth type assets. How and when should you apply the framework to take those big shots? All playbooks have a variety of different plays. Some plays are designed to get a yard. We're using football terminology here. A yard, 2, 5, 10. Other plays are designed to get, 40, 50, right? These big plays. They're the type of things you can implement when you need to, right? Maybe it's hey, you got to score. There's 30 seconds left in the game. You're down by a touchdown. You got to do it, right? You got to make that big play. Other times it's, hey, there's a penalty. Someone's offside. You have a free play. Let's use it. There are a multitude of ways and reasons why you would actually use these type of plays, but the short answer is in your playbook, in your portfolio, you need that type of exposure, right? It gives you that growth. It gives you those points on the board. And we're going to talk through how to actually allocate to investments that give us those big returns. Is it, just put all your money into gold or and the answer is no, right? I'm jumping ahead, but right, those are the compare and contrasting points that Mena, you're going to walk us through. So take it away.
Yeah, and really highlighting something that you said, your playbook needs to have a balance of these plays that get you, short predictable yardage and these plays that get you a lot of yards or put points on the board right away. Not having that hurts you in the long term. As a long-term investor, as someone who's trying to grow or maintain multi-generational wealth, you need those big plays. You need a balance of the solid plays that you can depend on and the nice trick plays that everyone kind of oohs and ahs about. And those together work really well. Now, you don't want a playbook with only trick plays because that absolutely never works.
They'll figure you out real quick, right?
Figure you out, yeah. And you'll have some explaining to do to your kids and grandkids, but you need a balance. You need to have the potency and really operate with that maxed velocity that we've talked about. And Eric's posted a great blog post on that max velocity of getting the big outcomes while also kind of being reasonable and only sprinkling those in when it makes sense and when you have either excess assets that you're not using in the immediate future or a long time horizon where you can take this risk. It's not really detrimental to you. It's not going to harm you in the short term.
Yeah, it's a great reminder, right? What we're talking about today is once a lot of these basics of portfolio construction are taken care of. Go back to the conversation we had around building your house. You got to have the foundation in place before you add the pool house or whatever the analogy is you want to use there. Playing the game before you're pitching as hard as you can before you're throwing downfield, right? You need the basics in place first.
Yeah, but when life gives you that opportunity, you definitely want to take it.
100%.
And then when you're taking the opportunity, I think what you should reflect on is like, all right, you call the right play, you're going deep, but you're also choosing the right receiver, which you can think about the right asset class to invest in, who you're throwing the ball to and who you hope is going to actually catch it and come down to it. And the analogy I'll use to make fun of myself is if you have Zach Miller, who was just nominated to be in the Hall of Fame.
Big shout out to Zach.
Yeah, big shout out to Zach there. If you have him as an option, or you have me, who's 5'10" on a good day, you need to throw the ball to Zach. If you throw the ball to me, you should be locked up for that. But it's really picking the right asset class. And the analogy that I'm making here is Zach Miller is venture capital. I am a non-venture investment. You can think
let me add. Zach Miller is well-structured venture capital.
Yeah.
You can say what you are there. I won't paint that picture.
I'm gold. I'm private real estate, a single stock that your uncle talks to you about. But yeah, like a well-structured venture portfolio is ideally predictable and reliable over time. It's going to generate the highest returns that you can achieve. You're taking on a lot of risk, but if you systematically take that risk on and build a portfolio of 1,000, 2,000, 3,000 early stage companies that are coming from the best managers and the best hubs, think about Silicon Valley, some areas in New York, you give yourself the highest possibility of success that you can possibly have, versus investing in that single stock. Like, the data is pretty clearly there. You are going to lose, like, the ball's probably not even going to get there, or it's going to get dropped, and you're going to lose the majority of the time. Gold, same thing. This stretch of time has been an anomaly, but we don't really have the confidence of saying, yeah, gold is going to outperform venture and small companies that create value, help people out, create intense, shareholder confidence, versus a metal that we don't have any predictability of if people are going to want it more in the future.
Yeah, that's right. I mean, it's an awesome framework to walk us through. At the end of the day, we're really talking about probabilities and stacking the odds in our favor. When we talked about the whole proper decision-making framework, you have to make quality decisions in the face of uncertainty. Making quality decisions in the face of uncertainty is not investing in one single startup, right? To your point, the vast majority of those go under. However, if you look at the asset class overall, and this is venture capital, early stage venture capital, exactly what you're saying, it's a phenomenal asset class. But you have to get thoughtful exposure and make the right decisions, again, going back to the decision-making framework, to capture that. You're not going to increase your probability of capturing that by investing in one random startup that gets thrown your way that, everyone else passed on the last 3 or 4 months, right? That's called adverse selection. That's a whole nother podcast, but you do not want to be subject to adverse selection. And so this is a high-level example, but super important, where you want to make decision under uncertainty. Venture capital has a ton of it, but we can structure a portfolio in a way that gets enough shots on goal, allocated in the right places, the right hubs of innovation, with the right managers who know founders, what a good founder is, versus just taking a random shot on gold or crypto, or again, using, the stock your dear uncle pitched you, right? Those are not good decisions. Well-structured venture portfolio, diversified with managers you trust and have incredible networks. That is a well-structured portfolio and likely to give you a higher probability of going deep and making that pass, making that reception, hopefully getting a touchdown.
Yeah. And one thing that I'll also add is kind of thinking about salary cap structure. A lot of the investments that we actually see are solid from the standpoint of, like, all right, it's a 6'4" fast wide receiver that's there that, you probably have good confidence in performing, call it well or semi-well. But it comes at a cost that is sometimes unreasonable. We see this all the time, where we have direct exposure to Perplexity. We see clients getting direct deals related to Perplexity where the person offering them, you mentioned adverse selection, is asking for crazy terms, whether it be on the management fee side or the carry side. So making sure that you're also making or taking these shots and signing these players to, call it, reasonable contracts, and this one wide receiver isn't on $50 million a year, where even if the outcomes are good, you're hindered maybe across the board or in other areas of your portfolio to actually get that exposure is a very important way of really looking at things and making sure that, you don't just have the right players on the field, but you have the right players with the right economics holistically to lead to solid results that actually end up in your pocket and someone's not taking home kind of your bag as well.
Yeah. Awesome. All right. That was a great conversation around this framework. Again, this is part of the playbook. It's not the entire playbook. You need the big plays to drive long-term multi-generational growth, but you need to do it in a really, really thoughtful way. And you need a few different ways of running these plays, right? It's not just all or nothing. But hopefully the conversation was super informative today. We're going to continue to try to apply this whole idea of making good decisions to investing over the next couple episodes, and then we'll wrap and move on to another topic and or series. But if you do have any questions, shoot us a text.
626-862-0355.
And until next time, own your wealth, make an impact, and always be a pro. Thanks for listening.